Good morning. Thank you very much for joining me for this morning's SURF webinar. My name is Denisha Sabji, and I'll be talking you through the June market performance, the SURF portfolio performance to the end of June, and then we'll take a look at the key macro and economic themes that talk to you around the context of where we position our funds, as well as some exciting new opportunities for the next while. I'll also remind you of our thematic satellites in the portfolio structure. Please feel free to type your questions in the chat box, and at the end of the session, we will take a look through all of them. So let's start with the June market performance, paying attention to the one-year numbers. As you can see, the JSE All-Share Index delivered 25.1%. Just below that, the JSE Swix Index had delivered 21.8%. The Cap Swix Index is just behind that at 27.6%. Quite a favorable return in terms of South African market equities to the end of June, having come off a very low base towards the end of last year, as well as June of last year. So we have seen a short-term market recovery in terms of the local economy, a lot of that being driven by resources. As you can see, to the end of June, 28.4%, and then industrials had delivered 17.1%. Financials came back quite strongly with a 33% return to the end of June. Within our Sygnia portfolios, we do, however, believe that the local economy will continue to have a lot of volatility for the next while, so we don't anticipate to see such strong double-digit returns coming through from South African equities for the rest of this year. Let's take a look at South African listed property to the end of 1 year, 25.2%. Also very nice recovery to the 1 year. If you look at the June month end number, 3.4%, and then over 3 months, also positive returns at 12.1%. However, considering the longer term track record over 3 years and 5 years, you can see that South African listed property continues to struggle. Within our Sygnia portfolios, we don't have any allocation to South African listed property directly. It was a decision that we had taken around 2019 to avoid that particular sector because of the fact that we did believe that there are a lot of valuation issues with regards to South African listed property. On top of that, the COVID-19 pandemic has accelerated further risks within that particular sector, even though we do see that over the 1 year number, this performance has recovered. We don't anticipate that for the next while, and even post the COVID-19 pandemic, that we will continue to see such strong returns. So we continue to avoid South African listed property. Instead, we have an allocation to international property. Then considering the returns of bonds to the end of 1 year, 13.7%, quite a strong return. It is the second best performing asset class just after equity within our portfolios. And we currently believe that there is a good risk reward continuum coming out of bonds within South Africa. Cash to the end of June delivered 4%, a very muted return, but of course this is a defensive asset allocation, so it's not meant to be invested in for the long term. And then in terms of Regulation 28 of the Pension Funds Act, we can invest 25% of the retirement fund savings in international markets, and we are favoring offshore equities within the US markets. You can see 14.3% to the end of 1 year. However, emerging markets just below that delivered a higher return, 15.8%. So we're currently experiencing a market cycle where the emerging market equities are doing much better compared to the developed market equities. Within our portfolios, we are currently underweight US equity, and we're starting to move into emerging market equities. We do believe that for the foreseeable future, this is where a lot of the portfolio performance will come from. And then taking a look at international property, you can see a 9.8% return to the end of June, very favorable, all converted to South African rands. Just below that, international bonds still struggling, negative 15.7% as at the end of June. Within our portfolios, we have no allocation to international bonds because of the very low interest rates we currently are experiencing across the globe, as well as the fact that quantitative easing continues to distort the value of those international risk-free assets. At the bottom of the screen, you can see the rand exchange against the US dollar. To the end of 1 year, we did see that the rand appreciated quite significantly against the US dollar. However, to the month in June, we've started seeing that some of those foreign exchange gains have been reversed, and the dollar did show some sort of an improvement, having increased around 4.1% against the South African currency. Let's now step onto the investment performance, starting with the Signature 70 fund. To the end of June, over 1 year, the fund delivered 18.5%, Skeleton delivered 16.6%, and then Synergy 70, 20.9%. Each of the high-risk portfolios delivered a return in excess of the strategic benchmark to the end of June. A reminder that the Signature 70 fund is a high-risk portfolio. Within that portfolio, we do blend active as well as passive investment philosophies. The Skeleton range is a purely passively managed fund, and the Synergy range makes use of the 4 largest South African equity managers within the domestic allocation, and then we use our Sygnia Skeleton range of portfolios for the passive offering. Then taking a look at the more moderate and conservative portfolios, Signature 60 to the end of June, 16.9%, Skeleton 60 at 15.2%, and then Synergy 60 at 18.3%. Once again, those particular funds have outperformed the strategic benchmark to the end of June. Signature 50 over 1 year delivered 15.5%, Skeleton 50 at 14.3%, and then Synergy 50 at 16.1%. The most conservative type allocations being the 40 range, lowest allocation to equity and a higher allocation to the safe haven type assets such as bonds and cash, have also been able to outperform the strategic benchmark to the end of June. Signature 40 delivered 14.2%, Skeleton 40, 12.8%, and then Synergy 40 at 13.9%. All of our funds across the 1 year time period has been able to outperform CPI at that point in time. If we consider the longer term numbers, so over 5 years, you can see that the funds do have single-digit returns across the various risk spectrums, and we have been able to outperform the benchmarks respectively for each of the portfolios. To the 3-month ended June, as well as the 1-month period, we do have slightly lower returns, but once again, ahead of the strategic benchmark. Over the 1 year period, we are experiencing strong double-digit returns, a lot of it coming through from the fact that the market cycle has started to recover. We have seen South African equities doing much better than they have done in the past, and we are also starting to see that bonds are continuing to deliver high real returns within the domestic climate, very different to what we're seeing internationally. Now stepping onto the investment performance when comparing ourselves to peers, we are looking at the surveys to the end of June, and starting with the Signature range of portfolios, you can see that over the 7 and the 10-year period, each of the funds across the various risk spectrums has respectively taken the first position against peers. Over 5 years, we've got the Signature 60 fund that has performed second best out of the 7 peers in the survey. Each of the other funds continue to remain in first place. Signature 70 has delivered the 3rd best position. And then if we look at the 2-year numbers, we've got Skeleton 50 at first place over 2 years, and Skeleton 40 and Skeleton 60 in second place compared to other peers. Over the 5-year period, our funds still have been able to outperform peers within the top 7 positions. Just to go back to the signature slide, I'm not sure if it may have skipped over, but as you can see, over 2 years, 3 years, 5 years, 7 and 10 years, signature 40 and 50 remain in the top performing peers. And then for signature 60 and signature 70, over 2 years, we were in second best place, and over 5 years, second best place. Whereas over the 3 years, 7 and 10 year numbers, we have remained consistently ahead of all peers. Then looking at the Synergy 70 fund, this particular fund over 3 years has been in second place, over 2 years, best performer out of all the peers, and over 1 year, third out of 3, the third position out of the 8 peers that qualified for the survey. This particular fund has a 7-year track record as at the end of June. Let's now step onto the actual numbers so you can see how we've stacked up in terms of the performance. To the end of June, Signature 70, Synergy 70, as well as Skeleton 70 has been able to outperform the average return of all of the other managers that have qualified for the survey to the end of June. You can see the managers at the bottom of the screen: Allan Gray, 91, Oasis, Ford, Prudential, Stanlib, just to name a few. So each of our funds across the various ranges has been able to outperform the average return of the combined returns of those members. What Alexander Forbes does is it takes the performance of each of the managers, it then averages them out, and it becomes the pure relatives benchmark referred to as the Global Large Manager Watch Median. Now taking a look at the numbers, so starting with the low equity multi-manager range of the survey, this is where the 40 funds feature. You can see Signature 40 at 14.2%, Synergy 40 at 13.9%, and then Skeleton 40 at 12.8%. Consistently over the 2 and 3 years, we have delivered returns ahead of other peers in the industry, with the double-digit returns coming through over 2 years. Over 5 years, 7 years, and 10 years, our Signature 40 fund gets closer to the top of the survey. You can see over the 10-year period, double-digit returns for Signature 40 at 11.3% and Skeleton 40 at 10.9%. And then looking at the low medium equity range of the survey, this is where the 50 funds feature. Synergy 50 delivered 16.1%, Signature 50 at 15.5%, and Skeleton 50 at 14.3%. Over 2 years, we've maintained the second, third, and the fifth position, and then over 3 years, the same is true. Over 5 years, 7 and 10 years, our funds get closer to outperforming the rest of the peers. And as you can see, as the 10-year numbers, fewer peers are available for comparison. That's purely because not all managers have such a long-term track record compared to our Skeleton and Signature ranges. Looking at the medium equity portion of the survey, this is where the 60 funds feature. Synergy 60 to the end of June at 18.3%, Signature 60 at 16.9%, and Skeleton 60 at 15.2%. Over 2 years, we maintained the second, third, and fourth place. Over 3 years, first, third, and fourth place. And then over 5 years, 7 and 10 years, our funds have outperformed all of the other peers. Now, considering the high equity range of the survey, this is where the 70 funds feature, Synergy 70 at 20.9%, Signature 70 at 18.5%, and Skeleton 70 at 16.6%. Over 2 years, you can see our funds within Synergy 70 as the best performer, Signature 70 within third place, and then Skeleton 70, which is that purely passively managed fund, still outperforming some of the single managers and the other multi-managers out there, 10.9%. Over 3 years, we are in first place, second place, and then just below that, Skeleton 70 with a 9%. We continue to do well within the passive space compared to some of the other managers within this particular range that do have active balance mandates, very different investment philosophies. Over 5 years, Synergy 70 delivered 8.7%. It was the best performing fund. Signature 70 delivered 7.9% and Skeleton 70 at 7.7%. Over 7 and 10 years, once again, our funds are ahead of most peers within the industry. Now comparing ourselves against the single managers, Signature 70, Synergy 70, and Skeleton 70, still delivering double-digit returns. We are quite proud of these results to the end of 1 year. Over 2 years, Synergy 70 was just behind Coronation with a 12% return. Skeleton 70 consistently delivers double-digit returns, 10.9%. And then you can see over 3 years, 5 years, 7 and 10 years, once again, our funds still feature in the top performers compared to the peers out there. So let's just step back to the 1 year number in case you may be wondering why it looks as though some of the managers within the multi-managed space appear to have outperformed us as at the end of June. One of the biggest reasons for that is that we are starting to see some of the peers out there recovering from a much lower base compared to where they were last year this time. Of course, that is recovering from the market cycle experienced due to the COVID-19 pandemic. We also see that some of the peers have had an allocation to South African listed property, which we have discussed has improved over the short term, and then they also have a higher allocation to South African equity, particularly resources, which has also experienced a short-term market recovery. So just for illustrative example, let's use the Momentum Classic 7 as an example. To the end of 1 year, they were at 21.8%. That same fund had delivered 7.2% 2 years ago. So that's just to give you an example of the lower base that I referred to in terms of which the manager had an opportunity to recover from. If you then look at the longer term track record for that particular fund, you can see much lower single-digit returns, whereas our funds continue to consistently deliver double-digit returns across the various timeframes, and ensuring that our members have consistent returns regardless of the various different market cycles we have to invest in. So of course, investing last year in the midst of the COVID-19 pandemic compared to 3 years ago or even 7 or 10 years ago, it was a very different market cycle. What we are showing you here is that our funds have been able to navigate the volatility, and despite the various different market cycles, we continue to deliver top performing returns. On this screen, we are looking at the volatility versus risk scatter plot. So we are quite comfortable that our Sygnia funds have achieved the optimal level of risk for the optimal level of return for the level of risk assumed. So comparing our Signature 70 fund to some of the other managers below here, which have taken on similar risk, they haven't been able to deliver as much of a high return as we've seen within the Signature range of portfolios. So all of our funds continue to fall within the efficient frontier, and we are quite comfortable that we are using our risk profile quite correctly in order to ensure that members are getting the highest possible returns. So now let's see how some of the various asset classes have performed for the first 6 months of the year. The positioning of the Sygnia funds have done incredibly well. As I've mentioned, we don't have any international allocation to global bonds. You can see that they delivered negative 12.3% to the end of June. We also have no allocation to gold that continued to struggle at negative 6.7% to the end of June. These were the worst performing asset classes. If we then look at the other side of the chart, I beg your pardon, taking a look at the MSCI value allocation, 13.7%, international property at 13%. This is where Sygnia continues to have an allocation in terms of our thematic satellites. We do believe that we must maintain an allocation to value because the growth cyclical recovery has not yet ended. You can also see the fourth industrial revolution funds as well as the FANG funds up quite nicely with double-digit returns, just over 12%. A reminder that the fourth industrial revolution and the FANG funds represent part of our thematic satellites where we are investing in disruptive technologies. South African equities didn't do too bad for the first half of the year. We saw a 10% return, and then in the middle of the screen, healthcare at 7%. So healthcare did have a bit of a slow start within the beginning of this year, but it has recovered quite nicely. And we are very excited because we also make use of the health innovation thematic satellite, where we believe that going forward, a lot of the international performance will continue to come from that particular theme. What we've also seen over the last few months is that there have been some great traction and, more importantly, more products that are getting approval by various agencies within the USA, which will allow for new products to enter the market and benefit patients and pharmaceutical companies alike. So that's not just for COVID-related vaccines, but across the spectrum of healthcare products. So generally, very good returns across most asset classes, and all of our balanced funds are delivering returns ahead of inflation, with only gold and bonds continuing to struggle. And then you can see Japan also having delivered negative returns for the first 6 months of the year. Let's now step on to the economics and markets discussion for the end of June. Here we have Dr. Anthony Stephen Fauci. He is the director of the U.S. Institute of National Allergy and Infectious Diseases. He is also the medical advisor to the president. What we've seen is that he started to call the Delta variant the greatest threat to eliminating the coronavirus. The World Health Organization has also described the Delta variant as being 55% more transmissible, making it the dominant force in terms of reporting the new number of daily cases. We do anticipate that for the next rest of this year, we must pay attention to any new variants that will continue to come out of this pandemic. On this graph, we are taking a look at the percentage of the population which have been fully vaccinated or received at least one vaccination to date. You can see that the developed markets like Canada, China, and Europe are dominating, where at least 50, 60, or even 70% of their population have received at least one vaccination to date. Very different compared to South Africa, which is right down here at the bottom of the graph. To the end of June, we had only administered around 4 million of the vaccines. That will change quite dramatically when we do experience an acceleration of the vaccination rollout, and we do anticipate that that will start happening from August, so next week onwards. What we have seen in terms of the vaccines is that where they do work, patients are expected to receive at least 2 doses. Within South Africa, we anticipate the Johnson & Johnson vaccine to be the largest rollout, and they have given us assurance that only one vaccine is necessary to eliminate this Delta variant. Very interesting to see that markets haven't necessarily reacted as negatively as they did when the initial onset of the coronavirus did start to impact on markets. What we are seeing is that globally, close to 41 million people are being vaccinated every day. Most of us have started to learn to live with the new normal. People have adjusted better to lockdowns, and governments have actually become more targeted in terms of their lockdown restrictions. They know which sectors need to be closed in order to support healthcare systems, and people have become a little bit more accustomed. A lot of that fear of the unknown has disappeared. Therefore, markets have been functioning quite efficiently. However, we do anticipate that there will be a slowdown in growth. However, over the short term, the Delta variant and the third wave of infections have not necessarily impacted markets as badly as it did last year this time. What continues to have an impact on markets currently is the Federal Reserve Bank. So on screen now, we're looking at Jerome Powell. He is the president of the Federal Reserve Bank, and almost a year after the onset of the global pandemic, the Fed is back in the limelight, now starting to discuss when and if they will end quantitative easing. So they are trying their best to reduce the impact on markets. We did see that during June, markets did experience a short-term knee-jerk reaction because of the fact that the dot plot showed that there is more likely to be 2 interest rate hikes by the next 2 years. Initially, investors were expecting no interest rate hikes. We did then see Jerome Powell coming out to reassure markets and to mention that they do believe that inflation is quite transitory. Going forward, we'll have to wait and see when and if they do start to unwind quantitative easing. For the next 5 months, we do expect that the Federal Reserve Bank will try and avoid any asset bubbles from forming. What we are seeing is that the property market in general and US equities are very expensive at the moment. So what they are trying to do is to cap any rally without having to raise interest rates too quickly. The reality is that an interest rate hike will be bad for the economy as a whole because it will start to raise the debt servicing costs. Within our Sygnia portfolios, we are underweight the US. It is our biggest funding position for the various other global themes and the geographic allocations. Another reason that we are quite comfortable with being underweight the US at the moment is because of this chart. It represents the large amount of liquidity that has been pumped into the world over the last 12 months. So every time that we saw a financial crisis, be it the most recent COVID recession or the 2011 Brexit or the previous shadow China debt crisis, markets reacted by taking on more and more debt. Right now, we are seeing global debt at a record high of 290 trillion US dollars. That's 360% of GDP. Going forward, the reality is that you need to be able to pay down this debt. And we do think that this large amount of QE, whether or not the Federal Reserve Bank decides to increase interest rates or to start slowing down the quantitative easing, we do expect that global liquidity will continue to roll over. That means that for the US market, we must continue to expect headwinds, and that's why we've decided to go underweight as far as those equity positions are concerned. Now moving on to China, so still talking about government control. One economy that continues to experience this is China. Here's a picture of their President Xi Jinping at the most recent ruling Communist Party founding centenary. Just imagine 100 years of the Communist Party ruling in China. He has committed to rebuilding the Chinese military and to receive reunification of Taiwan and social stability in Hong Kong. So he was quoted saying that any foreign forces that attempt to bully China would get their heads bashed in. Quite a strong message coming out from them. We need to be concerned with regards to growing power in the East, but certainly for now, we do believe that this particular economy will continue to do well. What's different in their economy is that they are starting to rebalance their growth, and it's because China does not want to be over-reliant on exports or the rest of the world. They want to be self-sufficient, and right now they are seeing a continuous organic drive of growth coming through from their middle-class population. Within our Sygnia funds, we are invested in the Chinese new economy sectors. We want to avoid the old economy sectors, such as materials and the commodity-linked sectors. On this chart, you are taking a look at the copper price. The dotted line represents relative to Chinese lending. And as you can see, in the middle of 2021, it did peak, and then we started seeing it beginning to taper off. This is one of the reasons why we don't believe that resources will continue to rally and deliver such strong returns as we did for the first part of this year. Going forward, we don't anticipate that China would import as much of the base metals that they have from South Africa like they did in the past. You can see that historically, China accounted for close to 60% of base metal use in demand. So even though their growth is slowing and becoming more focused on consumer type spend, less focused on materials and housing, it's definitely going to lead to a slowdown in commodity prices, metal prices, and all of those old economy sectors. Within China, it's very important to be placed on the right path when investing, and certainly this will also have an impact on the rand, because going forward, you know that the rand is very much linked to commodities and resources, which we expect to roll over within the next few months. So despite this, the Sygnia funds remain bullish on emerging markets, and we do think that strategically it remains a great place to be positioned over the next decade for a number of reasons. The original thesis, which remains, is if you look at the bottom right-hand side of this chart, is that Asia will see the largest increase in the global share of middle-class spend within the next decade. A rise in the middle-class population is very good for an economy. It's where all of the spending lies. So up to 75% of spending from middle-class population will continue to drive domestic growth within the Chinese economy. Going forward, we do believe that growth within China will continue to remain strong, and within Asia, it's good for emerging markets. We are quite excited. In the short term, we are also very excited because there's been a big divergence between emerging markets, which have lagged the US and Europe in terms of the COVID vaccination rollout. We are now getting to a point which is quite interesting, where that demand is starting to converge. So what's happened is that while emerging markets, particularly Africa, are way behind the vaccination curve, that started to accelerate quite quickly because of the low base, whereas within the USA, we're starting to see that the vaccination rate is starting to slow down. So initially, all of the very eager people went to get their jabs, and now we're at a point where the not so eager have avoided it, and emerging markets are starting to accelerate. So that convergence is going to help emerging markets recover at the expense of the USA. This refers to price action and vaccination rates. One of the other reasons why we remain very excited to be invested in emerging markets, in particular the Sygnia Emerging Markets ETF, is semiconductors. So semiconductors are core to everything from smart TVs to phones, cars, computing, basically everything that's connected to the internet. Everything that is smart uses a semiconductor. Right now, there is a shortage that's happening across the semiconductor space globally, and a number of cars have been put on hold because they can't get semiconductors to put into the big screens or the smart electronics. There's been a slowdown in the supply of cell phones and tablets because of the lack of semiconductor production, and what we have found is that Asia dominates the semiconductor production space. So South Korea has Samsung, Taiwan has TSMC, China has SMC, and basically Asia holds all of the major listed semiconductor foundries. The larger foundries are specialized in the incredibly tiny resistors within semiconductor production, so that continues to give them the edge. What's also very interesting is that it's not just production, but it's also research and development. If you take a look at the table on the right-hand side here, for the first time in 2020, you can see that China's research and development spend at 23.2% is starting to actually surpass that or meet that of the United States. So going forward, Asia will be the best place to not only produce semiconductors, but with research and development and the amount that they are spending on it, they are likely to be the best place to design semiconductors going forward. Within our emerging market ETF, we have 18% exposure to semiconductors. It's another great thematic reason to be invested within our particular funds. So not only long-term are we expecting the middle class in Asia to start to boom and spend organically in the economy, allowing it to grow, but the fund also has close to 5% exposed to semiconductors, and we do think that emerging markets which have slowed down over the past 3 months will continue to do better relative to the rest of the world and will pick up quite nicely as the price action and the convergence of the vaccination rates move closer towards the end of the year. Within our Sygnia portfolios, this is why we remain overweight China and emerging markets, which is currently financed by an underweight to the US. South Africa remains a mixed bag, and we still believe that we cannot go overweight South African equity until we have stable energy to support growth. Here we have our President Cyril Ramaphosa saying that there is no doubt that without the prospect of continued energy shortfall and further load shedding, it presents a massive risk to our economy.
The bottom line is that without stable energy, we cannot create investor confidence, which will allow for investment into factories and production, which ultimately will lead to growth. In June, we saw the President announce that the Department of Mineral Resources and Energy will be amending the legislation to raise the licensing threshold from 1 megawatts to 100 megawatts by the end of August. What remains to be seen is if in fact this materializes and that the 60-day threshold that was initially announced is adhered to. So the execution remains incredibly blurry. We will have to wait and see if what needs to happen does in fact happen and the embedded generation cap is lifted. One of the other risk factors that we continue to pay attention to was COVID. We did see an extension of level 4 lockdown within South Africa, and the new daily rate of COVID cases continue to rise because of the Delta variant. The liquor sales ban that was imposed during this extension of the lockdown period for 4 weeks saw the fiscus losing approximately 1.5 billion rand in tax revenue over the recent lockdown. Also some negative news on municipalities where only 27 of those that were assessed out of the 257, almost less than 10%, were actually cleared for business. So SAICA's findings have indicated that over the last 5 years, we have lost close to 1.5 trillion rand to corruption. Can you imagine? This could have almost financed a decade's worth of infrastructure within our country. Unfortunately, the recent civil unrest that started after Jacob Zuma was arrested saw the rand slump to its weakest level against the dollar in more than 2 months. So that reversed a lot of the positive gains we experienced on our offshore allocations, and we did see that the rand was behaving as the strongest emerging market currency prior to the civil unrest unfolding. This chart on the right is showing you the rand over the last 25 years. It's from RMB, and the fitted line represents, this fitted line which is not moving, represents the interest rate parity for the rand. It is a rand dollar chart, and it is illustrating that the rand continues to be a function of inflation differentials between the USA and between South Africa over the longer term. However, over the shorter term, there are various deviations to the downside, which is currently being driven by 2 things. The first is commodity prices. So when commodity prices are very strong, the rand strengthens. On a pure commodity basis, if you were to ignore growth and inflation differentials, the rand could be as low as 13 rand. And we did see us getting to just below 13.5 recently. If you were to ignore commodity prices and just look at the growth forecast with the current lack of reforms within our country, then the rand should be trading at around 16 rand. So putting it all together, strong commodities, South Africa with a lack of reforms, we have our year-end target at about 14 rand or 14.5 by December of this year. We do think that the rand will continue to weaken from that point with a lot of volatility, but depreciating in line with inflation differentials. So right now it means that it is a very good time to be overweight international allocations. You can see certainly that the rand spends more time being weaker in relation to inflation than it is stronger. Anything below 14 or 14.5 is a good time to go overweight offshore. And within our Sygnia portfolios right now, we do have an overweight offshore allocation. And then looking at the yield curve within South Africa, it remains relatively steep, partly because the short end of the curve is very low. The repo rate of 3.5% is slightly below inflation at the moment, and that's because growth is so low and because we are in the 3rd wave of infections. So the South African Reserve Bank has delayed raising interest rates. We are getting negative real returns on the short end of the curve. However, across the bond funds, we are seeing really good returns because of the fact that foreign investors have got no confidence in South Africa at the moment. They are very worried about a lack of returns, as well as Eskom and the continued load shedding we've experienced for the first part of this year. So despite South Africa having some of the highest bond yields across the globe, foreigners remain nervous to be invested. And as a result, it means that there's a lack of supply here, which means that the yields remain quite high. As a result, the yield curve is nice and steep, which is an early opportunity for investments. Now taking a look at our portfolio positioning, across all of our balanced funds, we remain overweight South African bonds because we do think that there is a good risk-reward return. We don't hold any global bonds because of the negative yields in Japan and Europe and very low yields within the US markets. We are underweight South African equity because of low growth, the lack of stable power generation, as well as low investor confidence and the slow execution of reforms. We are also underweight money market and income positions because of the very low interest rates within South Africa right now. And we are overweight global equity because of the rand is looking quite expensive, and we like exposure to our thematic satellites. Also, there's such a fantastic range of diversified growth in our thematic satellites, which are technology, emerging Asia, and healthcare. We also invest in international property. This represents our value tilt on the fund. Here we make use of the Sygnia Itrix property exchange traded funds. We prefer to be invested in specialist sectors such as cell phone towers, data storage facilities, and hospitals. Within our disruptive technology theme, we are investing in the FANG Plus Equity Fund that represents Facebook, Apple, Amazon, Netflix, and Google. We also have an allocation to the Fourth Industrial Revolution Fund, which tracks the Disruptive Innovation Index, and here we are paying attention to futuristic trends. The third satellite is emerging Asia. So we've spoken about the use of semiconductors and the fact that the middle class population continues to earn more, therefore spending more. We also see that growth within emerging markets such as China continues to outperform that of developed markets such as the USA. There has also been some research that has come out from the World Bank as well as the International Monetary Fund that within the next 3 to 5 years, an economy such as China can actually surpass and eclipse the size of an economy like the USA. The fourth thematic satellite is health innovation. So within that particular fund, we do believe that healthcare research and development will continue to do well. And this is over and above just research for COVID. And then the last satellite within our portfolio is infrastructure. This represents a local only portfolio. Infrastructure is a nice fifth wheel to have to any portfolio because we find that the returns you earn within that particular sector is uncorrelated to what we receive within South African equities and bonds. Infrastructure represents an avenue to invest within the South African market and maybe give us the much needed growth boost that we require. Within this particular satellite, we are looking at long-term projects such as road infrastructure, water infrastructure, perhaps even green power. Right now, our allocation within the funds, there is nothing towards infrastructure, but as and when we do have an opportunity to invest in a project that we believe is sustainable, we will then have the opportunity to do so. If we take a look at the Fourth Industrial Revolution in a bit more detail, this slide is showing you the top 10 holdings to the end of June. You can see that the fund is made up of well over 380 different constituents. And some of those constituents are in as many as 4 different subsectors. So that means it's very well diversified across different sectors. And you can see that we're making use of 3D printing, solar-powered energy, virtual reality, nanotechnology, robotics, advanced transport systems, drones, very different allocations to futuristic trends that we believe will continue to do well and will continue to give our Sygnia portfolios an edge compared to peers when investing into the future. some additional information with regards to health innovation and why we believe this particular theme will continue to succeed into the foreseeable future. First and foremost, the fact that research by DHL and McKinsey have suggested that almost 28.5 billion vaccines will be required to end the pandemic by 2023. So as you can see on this chart, each of the pharmaceutical companies, we are comparing their Q1 profits to their Q2 profits, and each of them are starting to show a significant improvement. And like I mentioned earlier, over and above just research for COVID vaccines, there are other products that are being approved by healthcare companies across the world, which we believe will continue to do incredibly well into the foreseeable future. Healthcare companies are also relatively cheap compared to their history, and on this chart, we do see that their earnings continue to improve. What's also very interesting is that we are seeing that additional medications and new developments are being found as research continues for the COVID-19 pandemic. So in time to come, we will see a lot more successful trials being rolled out. In terms of what comes next, we are going to introduce our new Solactive Healthcare 150 Exchange Traded Fund by next week. It is launching on the 6th of August officially. This particular fund will give investors an opportunity to invest 100% in international healthcare companies within developed markets, and it is suitable for any investors that are seeking higher returns and those that are willing to tolerate higher volatility. So we continue to look for additional avenues for our members to enhance their portfolio returns, and this new Itrix that will be launched within the next week is something exciting that you can follow our social media pages on in order to see what happens after this. So that brings me to the end of the formal presentation. I'd like to take a look if there are any questions or comments that have come through. Nothing at the moment. I appreciate your time. Thank you very much for having joined me this morning. Please feel free to send any of your questions or comments through to us, and please send us some of your feedback as well as your suggestions for any future topics. Thank you so much for joining me. Please continue to stay safe and have a blessed weekend. Goodbye.